The VAT Amendment Bill of 2026 is not just an update, it is an aggressive restructuring of Sri Lanka's revenue mechanics. By abandoning passive tax collection, the government is forcing an expansion of the tax base and integrating real-time digital enforcement directly into daily commerce. For corporate controllers and tax professionals, the compliance window is now closing rapidly. The primary enforcement mechanisms activate on July 1, 2026. To understand the exposure risks, we have to deconstruct this legislation into a three-part compliance matrix. First, the legislation forces a massive expansion of the tax base. Second, it applies precise, sector-specific surgeries to extract revenue from targeted industries. Finally, it secures the perimeter with a real-time digital enforcement architecture. Failing to map how these three pillars intersect will expose entities to severe corporate liabilities. We start by looking at the sheer volume of entities the government is pulling into the formal tax net. Under the previous regime, the general VAT registration threshold stood at 60 million rupees annually. This chart details the mandate. Effective July 1, 2026, the annual threshold drops to 36 million rupees, equating to 9 million per taxable period. That 40% drop is a deliberate dragnet designed to capture tens of thousands of mid-market and small to medium enterprises. Domestically, the physical tax base is expanding. Internationally, the government is executing a parallel capture of the digital economy. Non-resident digital service providers rendering services to anyone located in Sri Lanka are now fully within scope. These providers face a rigid compliance timeline, requiring mandatory registration within 3 months of the liability arising. However, as this flow path illustrates, there is a strict bifurcation. Direct-to-consumer digital services trigger VAT immediately, while business-to-business transactions feature a specific carve-out. To legally bypass the tax, the local recipient must be fully VAT registered and possess the appropriate verifying documentation. By closing these historical blind spots, the distinction between physical borders and borderless digital commerce has been completely erased for tax purposes. The second pillar of this overhaul applies the expanded tax rules unevenly, extracting heavily from some sectors while subsidizing others. The financial services sector absorbs the heaviest impact. Look at this margin adjustment. The VAT rate on financial services ticks up from 18% to 20.5%, effective July 1, 2026. Furthermore, the definition of emoluments is now technically aligned with the Inland Revenue Act of 2017. There is a specific exemption built in. Dividend income is explicitly excluded from being treated as business profit under Section 25F, provided specific conditions are met. While domestic finance faces margin compression, industries capable of generating foreign exchange receive preferential treatment. Effective October 1, 2025, services provided to overseas buyers by registered garment buying offices are zero-rated. This zero rating is heavily conditional. It requires the payment for those services to be received entirely in foreign currency. Similar protections extend to entities designated as businesses of strategic importance. These broad exemptions remain aligned with the regulations set out under the Colombo Port City Economic Commission Act. The government is deploying VAT as a surgical instrument, raising the cost of domestic finance to subsidize the generation of foreign reserves. Expanding the base and adjusting the rates requires an enforcement mechanism capable of actually collecting the revenue. The legislation introduces a sweeping hardware mandate. All registered persons must adopt secured point-of-sale machines approved by the Commissioner General of Inland Revenue. This schematic details the required operation. The localized point-of-sale terminal must capture and transmit encrypted transaction data directly to the Central Tax Authority in real time. Businesses have exactly 3 months from the official implementation date to install this approved architecture. Strict limitations are also being placed on deductions. Input tax is fully disallowed on deferred plant and machinery imports if those assets are not re-exported within a month of project completion. By contrast, newly registered retail and wholesale traders are granted a transitional benefit, a deemed input credit on unsold physical stock held at registration. Operating outside these strict new parameters triggers immediate penalties. As this comparative scale demonstrates, the baseline maximum fine for offenses jumps from 25,000 rupees to 1 million rupees, a multiple of 39. For specific offenses, that financial penalty is now accompanied by up to 6 months of imprisonment. These criminal provisions strictly target fraudulent refund claims, the concealment of material facts, and the failure to furnish valid tax invoices. To ensure compliance, the tax authority is authorized to publish the names, TINs, and registration status of any entity, utilizing transparency as an enforcement tool. Under the new legal framework, administrative noncompliance carries severe financial, reputational, and criminal exposure. These three legislative shifts operate together to form a singular and escapable regulatory net. Sri Lanka is moving completely from a system of passive tax collection to active, technologically integrated enforcement. Finance teams must immediately audit their IT infrastructure and procure CGIRR-approved hardware. Controllers must urgently recalculate pricing and margin strategies to absorb the 20.5% financial services rate. And supply chain managers must rigorously verify the VAT status of all digital and local business vendors to protect their input exemptions. Under the new 2026 VAT regime, data transparency is absolute, and operational ignorance is now considered a criminal offense.